everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, I want to start things off with kind of a controversial statement, but I want our more veteran options traders in our audience to give me some feedback. Tell me if you would agree with this statement. Sometimes an options seller's market may actually be a great time to buy options. What do you think? Yes or no? Chat in, let me know. Just a quick Y or N if you agree with that statement. But I'm gonna discuss just exactly why yes. Sometimes when we see what's known as an option seller's market, for some traders, they see that as a potential opportunity to buy. So I'm going to be laying out the logic for that argument. We're going to be planning and placing an example trade on that premise. But before we can get to any of that, though, let me first of all say hello to everybody who's already joining us out there in YouTube. Great to see all the familiar names. Great to see some new names. But hello there, Life in the Fast Lane, Eva, Frank, Will, Lawrence, Richard, Olga, Kevin, Jay Richardson, Greg, and on the list goes. Always great to see you returning veterans. Great to have you here. If you are among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has already concluded, we'll enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern. Now, I also want to let everybody here in my live audience know that my very good friend Mike Fairborn is going to be hanging out in the chats. Mike's already been keeping an eye on questions that have been coming in. And what he'll do is if a question comes in and I can't address that just during the flow of the presentation, he's there to pick up my slack. So thanks for having my back there, Mike. Mike and I would also strongly recommend that you follow your favorite Schwab presenters on social media. You can find and follow Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find and follow me on X at Cameron May CS. And you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. All right. But I saw a lot of Y's in there. Yes, yes, yes. Jay Richardson says, yep, sometimes the seller's market may represent an opportunity for buyers as well. Bill, yes. Frank, yes. Life of the Fast Lane, yes. Lawrence, yes. Olga, yes. So I want to talk about why that might be the case. But before we do, of course, we need to pause to consider the risks associated with trading options and other trading and investing approaches. So bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including a loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's set an agenda for today's discussion. I want to start things off with a quick look at the stock market and the options market. Talk about why for some they may view current conditions as a potential seller's market, maybe in particular for bullish sellers. We'll see. We'll see. Obviously, things can change on a dime. But I also want to use those same market conditions to set the stage for a discussion of how those might be opportunity for buyers as well of options. So I'm gonna reframe the traditional discussion around a buyer's market or a seller's market for options, and then we're going to run a scan for some potential options trade candidates, and actually going to be placing a buy order today. All right. So Kevin says maybe if options are more expensive, higher likelihood of a bounce. Interesting observation there. Stacy says, you're just a beginner? Well, welcome, Stacy. Everybody has to start somewhere along their own personal learning curve. You don't understand why the call option is so much cheaper than the ticker share price. You've read out a lot on options. You don't see the answer to your question. I'm going to try to work that in, Stacy. Forgive me if I don't quite get it shoehorned in there, but I'll try to explain that as part of our discussion. All right. But let's get into today's market conditions. So here's just a quick backdrop on what's happening with stocks. I don't think this is going to be a huge revelation to very many people. The S&P 500 has been sort of trapped in the sideways channel between about 6,600 and 7,000 now for about 6 months. This is a 12-month chart, and you can see going all the way back to mid-September, we've closed every single trading session except for two. There was one there and one there, where we closed below 6,600, but then just immediately went back up above. Every other trading session has closed above 6,600, but below 7,000. So with this as sort of a backdrop, what some traders will do is they'll look at this sideways channel and they'll look to decide, well, are we closer to the bottom or closer to the top? Because if that recent history is any gauge for what may be around the corner, and obviously history is not a guarantee, but they may look to see, are prices low and set to rise or prices high and set to fall according to the recent patterns of behavior. And let's just say that our would-be trader here sees that prices have come down, positioned just above that 6,600 level, which has been so important over the last 6 months, and maybe they think it's more likely that the S&P gains headway over, let's say, the coming month. So how about we look out to this April expiration? Let's maybe plan our example trade around that April expiration, okay? Option Hound said, so happy to be here. Great. All right, so that's going to be our stock assumption. Let's just say that our hypothetical investor here or trader is bullish. Well, when we're bullish, as an options trader, we can do all sorts of strategies, but stripping it right down to basics, buying a call is bullish, and so selling a put. So buying versus selling is our next question. So is it more of a buyer's market or more of a seller's market for options traders? Well, here's a chart that many options traders will turn to in their effort to address that question. And this is just a chart of the anticipated volatility of the S&P 500 over the next 30 days. And sometimes expectations of volatility are high. Sometimes expectations for volatility are low. And interestingly enough, those expectations have a strong influence on the general pricing of options. When volatility expectations are high, there tends to be heavy demand from options traders, okay? Because the speculators may see all that expected volatility as potential. And so maybe they're out there buying calls and buying puts and entering into speculative positions. Hedgers may see all of that expected volatility as risk. And so now they're also out there trading options, but maybe potentially to hedge big stock positions or stock portfolios. But demand, when volatility is high, demand tends to go up from speculators, but also from hedgers. And as demand goes, so typically goes price. Yeah. So for some options traders, they just see this as a chart of general pricing of options. Options back here in April were very expensive for lots of stocks out there compared to what they typically were at other times. Options here in around Christmas were quite inexpensive. This is when options buyers were finding the lowest priced options of the last 12 months. Oh, hey, thank you. Somebody just chatted in, says you're also a beginner and you really like my sessions. That's very good to hear. Yeah, so let's bottom line this VIX chart. And I'll say that for some options traders, they'll describe this as when volatility spikes and options premiums jump up and they start to fall, they may actually describe that as a seller's market because isn't it typical, like if you're trying to sell your house, you wait for the market to peak and then you try to sell right at the peak, get the most out of the house? Isn't it true that if we're trying to sell a collectible, we wait for a spike in the demand for those collectibles and then we sell when prices are at their absolute peak? Yeah, so that's sort of a traditional seller's market approach. Now, to the opposite extent, when volatility is low, this is commonly described as a buyer's market, because prices are cheap. Demand is low, prices have fallen, and so buyers might find, oh, look at this, I can buy a call or I can buy a put at levels much lower than I might have had to pay for a similar call or a put at other times. So here we go. Seller's market, buyer's market. Guess what? Not everybody agrees with that premise. Why would they not agree with that premise? Well, there's a reason, and I've already sort of laid it out for you, but there's a reason why in around Christmas, options were so inexpensive. It's because traders weren't expecting much to happen. And so for some, they would look at someone who's buying an option at that time as kind of a sucker play. Now, obviously, nobody knows the future, so it's only an opinion. But I want to tell this same story in a different way. Let me give you two trade scenarios. We have Trader A and Trader B. Trader A is entirely price focused. And so they scan the markets looking for the cheapest options, and they find one on a stock. Ooh, look at these options, are dirt cheap. They don't bother to check that stock's history. And if they were to look over the last 12 months, that hypothetical stock, let's just say that it's gone nowhere. It's a $100 stock. It was a $100 stock last month. It was a $100 stock last year. It hardly moves an inch over the course of a month. And so Trader A is attracted to the low price on that option. And so they buy that inexpensive option, and it gives them the contract where they can maybe buy the stock at any time for the next 30 days. And now they're excitedly waiting for the stock to make a big move so they can make a big profit. And that stock does what it does, and it just does nothing. And it turns out even their expensive investment was a waste, and they lose that investment. Now, Trader B looks for volatility. And when they're looking for volatility, they find that the options on those volatile stocks are more expensive, but for a reason. Let's say that stock B that they find here, it's $100 right now, but last month it was a $200 stock. Then the month before it was a $50 stock, and this thing is just up and down all over the place. And so Trader B recognizes on a stock that moves like this, if the timing is right and that volatility goes in the correct direction, ooh, there's a lot of money that could be made there. Now, if we were to frame those two stocks as traditional buyer's markets or seller's markets, it would actually be the first stock that would be described as a buyer's market for options traders. And the second stock might be described more as a seller's market because it has such high priced premiums. Does that make sense? That's the way some traders see this behavior. They may actually see these highly volatile market conditions as representing, yes, higher options premiums, but they're willing to pay those higher premiums in pursuit of stronger return potential. Now, obviously, that can settle down, and if the markets get quieter after that, it may actually be that they got excited and it was too late and the excitement passed. That's a possibility. But I did want to talk about why, for some traders, they see these sellers' markets as more of a buyer's market condition. And so we're going to say, let's put ourselves in the shoes of that Trader B who's actually looking for volatility, willing to pay higher premiums, but hopefully with greater potential as a result. Let's see. Peter says, I bought the options last week. Now what? How do I exit? How do I read it on thinkorswim? Peter, it's a good question. I can't guide you through your personal trade. I will be doing some trading here today, so you can see that. But if you need a little one-to-one assistance, it might be worth calling support. Okay, 800-435-9050 is that number. But let's go scan for some higher volatility stocks with some higher priced options, as much as that might sound counterintuitive, and do some buying. So for this scan, right now you'll notice I'm on the simulated trading environment. This is known as paperMoney on thinkorswim. Now, if you're not familiar with thinkorswim, this is software that can be downloaded free of charge from within your Schwab online account. You just go to the trade tab on your online account and then look for thinkorswim. Click on that, it'll guide you through the process. All right, but there are two versions of thinkorswim. There's a practice platform known as paperMoney, a simulated trading environment, and then there's the real account. Yeah, you can actually access and trade your real balances. Now, I actually have a fake real account to use, and I'm going to be moving over to that because I'm going to be using a feature that's not available on paperMoney. We're going to go do a scan that has to be done on the live platform. So let's move over here to the live platform. I just changed the background to dark, so it's a quick visual way for me to tell whether I'm looking at my paperMoney or my live platform. You can also just look up here and you'll notice it doesn't say simulated trading anymore. That's a big Q. This is still, though, just a practice account, just a fake account. But in any case, let's build a scan. And I'm not going to make this one complicated because this webcast series is called Getting Started with Options. But let's say that we have an options trader who's looking for some volatile stocks to trade. Yes, they may come with higher premiums that some might label more of a seller's condition than a buyer's condition. But how might they find those? Well, first of all, liquidity can be a priority for lots of options traders. So let's look for highly liquid stocks, hopefully with more liquid options than on less liquid stocks. So on the scan tab, I'm just starting with a clean slate here. I'm going to use one of the default stock metrics, and let's choose market capitalization, market cap in millions of dollars. And for our minimum, I'm going to ratchet this up. Let's say we put in 100,000. What that means is we're looking for stocks where the market capitalization or the value of that company is at least 100,000 million. That's a $100 billion company, right? That's going to be some of the biggest companies in the world. There are probably going to be a few hundred that meet that criteria. Now, next up, we're going to enter a requirement for the volatility of those stocks, because some of those very large companies are really actually pretty stable. They don't move very much. Now, they can, as a result, have kind of cheaper options, but that's for a reason, because they don't move very much. So I'm going to use a gauge of volatility here for our next metric. And for that, we're going to choose beta. Eva says you can't read the dark. Should you sign off? No, Eva, we'll only be here for a couple of minutes. You don't need to sign off. You can if you want to, but we'll be back on the lighter platform in just a moment. In any case, our beta is a gauge of volatility. And really what we do here is we benchmark the stock against the S&P 500. And if our stock just tends to move with the S&P, we'd say it has a one-to-one relationship with the S&P, or in other words, it would have a beta score of 1. Now, if it tends to move with the S&P, but it moves faster on its way up and faster on its way down, if it's more volatile, it would have a beta score above 1. And I'm going to require at least a beta score of 2. This would be stocks, these would be $100 billion stocks that move at least twice as fast as average, as measured by the S&P 500. So these are more volatile stocks. Now, finally, some of these big companies that are traveling very rapidly, they might be in steady decline. And yet we just set the stage here for an options trader who thought stocks are going to go up. So maybe we're looking for a stock that's more bullish than bearish. So let's put in a final criteria. And that final criteria is just going to be what the trend of the stock is doing. So I'm not actually going to do that using this stock metric. We're going to remove this third one and replace it by adding what's known as a study filter, a technical study or a technical indicator. So adding this study filter, and that is the feature that's not available on paperMoney. So if you're trying to repeat this on paperMoney, you're not going to find this. It's going to be disabled. But on our live accounts, we can do a study scan. And here, we're just going to make a requirement of what price has been doing. So let's go to our study. We're going to click on the menu. And we're going to go to price performance near high lows. This literally just means we can specify how close price is to a high or a low over a specified time frame. So I'm going to choose near high lows, and I'm going to say that we need our price to be at least within 5% of the 252 trading day, or that's actually 1 year. A typical calendar year has 252 trading days in it. So we want the current price within 5% of the 252 daily high. All right. That's it. That's the whole scan. Big companies that are volatile and going up. So we're going to run the scan, and guess how many we have? 2. Yep. There are lots of big companies. There are 350 of them. Some of them, but there are only going to be maybe less than a third, I would guess. I don't know exactly, but probably less than a third of those that are at least twice as volatile as average. And then finally, among those, a lot of those get their volatility because of crashing downward. So we're looking for those that are basically kind of crashing upward. So that leaves us with SanDisk and Vertiv. So I want to look at what's going on with SanDisk first. And I think this is going to be an interesting revelation here for some. Let's pop back over now, Eva, to our white background. I want to bring up SanDisk. And here's SanDisk, and I've made some drawings here. Ignore these boxes for just a moment, but these lines for, let's say, a bullish trader, This is kind of interesting. SanDisk is this company that gets up and moves. Now, this is not a sales pitch for SanDisk, but is it a volatile stock? Well, this stock over the course of just the last 6 weeks has gone from $530 up to $690. It's a $160 move up. It even went a little bit beyond that. And then it came right on down, and then it did it again, and then it came on down again, and then it did it again. These are 130 to 150 point swings on a 500-ish stock. We're talking about something that's moving like 30% in a couple of weeks. That's a lot of volatility. And for an options buyer, hey, if we buy and the stock happens to repeat that behavior and it goes up another $130, how much money can be made on that? Could be a ton, right? Could we also lose? Absolutely, we could lose. So we're going to have a plan for both of those scenarios. So this is the kind of stock that for some traders, this is just the sort of behavior they're looking for. Now, I want to frame that though. If we were to say, is this more of a buyer's market or more of a seller's market for SanDisk options, how can we see that? Well, there's actually an indicator right here on thinkorswim. It's known as implied volatility. It's kind of like the VIX chart, except the VIX chart is for stocks in general, and implied volatility is for one stock specifically. So I'm going to go to the little flask icon here, and I'm going to type in IMP for implied volatility and add that to our chart and click apply. And what this is left with, what this leaves us with, and obviously I made these drawings. If you're wondering where this stuff came from, I used the drawing tools down here to draw in some boxes and some lines and some text. All right. But a traditional buyer's market would be identified using implied volatility. We would look for this sort of thing where our implied volatility is low. So if you're not familiar with the implied volatility chart, it's also a gauge of volatility expectations from options traders, but not about markets, but about this stock. Sometimes options traders expect a lot of volatility, and you'll see the implied volatility. Think about the name, implied volatility, expected volatility. Yeah, you'll see this line rise. Now, when it's up high, what that translates to is that the options prices on SanDisk go up as well. If there's a lot of expected volatility on SanDisk, we'll see the demand for options on SanDisk go up and the prices go up. So with high prices, traditionally we might describe this as a seller's market. Well, the seller's market here, look at this. Look at the time frame when our implied volatility was high compared to when it was low. And One Morning Rush says, Cam, the beta of 2 is highly volatile, isn't it? Yes, and that was by design for this discussion. This is for a trader who is looking for a stock where they can buy an option, and this stock has an expressed history of movement. We could easily look for a very low beta and find stocks that just haven't moved very much, but this is taking the opposite approach. We're a buyer whose plan is to be more aggressive, recognizing that aggressiveness and volatility comes not just with enhanced possibility for success, but also there's going to be more risk, no doubt. Yep, it is volatility. But I want to look at this period that might have traditionally been described as a seller's market for SanDisk, but let's put ourselves in the shoes of a buyer of call options during this time frame. Did we pay a high premium? Almost certainly. Yep. But this stock went from $240 to $300 to $400 to $500 to $600 and $700 in a matter of a few weeks. So do you think a call buyer might have had enhanced potential return during this time frame if they were good enough to catch that sort of timing? Yes. Now, could it just as easily have gone down? Certainly. Yep. So we need to plan for both outcomes. So this seller's market actually represented probably the strongest potential for profit for SanDisk traders in a long time, if not in its entire history. Now, if we look at the buyer's market in contrast, well, we might have purchased a call here or a put, whatever, and we find ourselves 2 months later having paid for an inexpensive option that delivered zero value. Congratulations. Yes, we bought when prices were low, and prices just stayed low. They were low for a reason, because the expectation of volatility was low, and that's actually what played out. So I think this can be an interesting reframing. This is not the way it always works, but for some traders, they actually do see high levels of volatility as just carrying more potential, but also, of course, accompanied by significantly increased risk. So, pardon me, that's what's going on with SanDisk. Let's go see what's going on with our other stock. It was VRT. So there it is. With apologies to Eva, it says VRT right there. Let's go back to our lighter background and look at VRT. And let's look at where implied volatility is right now. We're actually at a relatively elevated level of implied volatility. The expectation for volatility on this stock is higher than at most times over the last 12 months. There have been exceptions. There was a period of about a month back here when volatility was higher. Premiums would have been likely higher still. Here we had a spike in premiums. Here we had a spike in premiums. But we're still higher premiums than most of the time over the last 12 months. Well, for some traders, they're perfectly fine paying those higher premiums if the stock can get on its pony and ride. Sorry for kind of a lame, what would that be? Metaphor? Anyway, yeah, if this can get up and go, it might be worth paying those higher prices. Let's see, just had a question there. From Lack to Legacy says, would this be a good time to sell cash secured puts? Okay, well, it's a good question. Again, that would be a bullish strategy. Yep. Whether it turns out to be a good time to do it or not always comes down to what happens next, right? I'm going to be buying a call, which is a bullish strategy. Selling a cash secured put is also a bullish strategy. If the stock goes up, both those strategies could work out just fine. If the stock goes down, both those strategies could fail, and fail relatively spectacularly. So what happens next will decide whether it's a good time or not. But would that be a logical trade given the sort of premise that I've laid out here? It could be. Yep, you might be getting high premiums right now. But in any case, we're going to be buying. All right. Now, I'm going to try it. I had a question that came in. Why are options cheaper than just buying the stocks? That question came in. I'm going to see if I can work that answer in here. I'm just reading to make sure I'm not missing any other questions. Oh, nope, I think I'm good there. All right, but I wanted to talk about something in the price behavior on Vertiv. As long as we're familiar with the fact that we're probably going to be paying some kind of higher priced options premiums right now, here's why. Well, Vertiv has been moving in a fairly rhythmic pattern recently. It's been running up $40 and then pulling back for a few days, and then running up $40 and then pulling back for a few days. You'll notice here it went from about 148-ish and it went up to about 184-ish, something like that. Close to $40, that was more like 35. Here we went from 158 up to about 200. That was like 42-ish. Here we went from 170 up to about 210, and then gapped another $40. That's why I put this green line in here, which sort of distinguish this as sort of a move followed by another move. So here's a $40 move, and then an immediate additional $40 move, and then a couple of days of selling, and then about another $40 advance, and a few days of selling, and another $40 advance. And recently there's been a couple or 3 days of selling. So let's just say that our trader has looked at this and thought 1, 2, 3, 4, 5, 6 times this stock has made a nice little move, $40 to the upside. If it can do it one more time, maybe there's potential there. So if we're just bouncing off of about 260, maybe the stock might head up toward 300. Let's go buy a call and see if we can benefit from that if it happens. Okay. So let's go to the trade tab. And what we're going to find is that these are not going to be terribly inexpensive options. This is a stock that gets up and moves, and that can increase its demand from speculators and from hedgers. So let's look at maybe the 17th of April. You'll notice these moves have been happening in a week or two. They haven't taken very long. So if we buy a 31-day contract, that may be enough to capture the next move if it happens. So let's go to, let's see, our stock's trading right around, what, 260 to 270? Let's look at the 260 call for the 17th of April. And let's outline this. These are facts from another discussion, so I'll just delete those. This is going to be our example trade. We're going to buy a call. And we're going to buy a call at a time when some might say, hey, it's more like a seller's market for Vertiv options, isn't it? Aren't the options kind of high priced? Yeah, they're high priced because this thing just moves. So Bruce says, if you're talking about a seller's market, why are you looking to buy? Bruce, yeah, you may need to go back and rewatch the premise that I said at the start of this webcast, because the bottom line is when options are expensive, they're expensive for a reason. And it's because the stock is moving a lot, and that movement can represent profit potential to a buyer. That's why for some buyers, they're totally fine with higher priced stocks at volatile times when higher priced options at volatile times on stocks, when for some, they might say, isn't that more of a seller's market? Maybe, yeah. But we're going to be buying a call. 17th of April, the 260 call. It's not inexpensive. It's probably going to cost us close to $24. Let's say that we're able to buy this. We buy the 17th of April 260 call for $24. So there was a question that came in right at the start of this webcast, and I said I'd try to address it if I had time, and I think I have time. So let's see if we can squeeze this in here. Why is this so inexpensive compared to just buying the stock outright? Because we can buy this call, and even though it's going to be $2,400, if we wanted to buy the stock itself, that would be a $26,000 investment. That would be, it's more than 10 times. It's about 11 times the cost to buy the stock versus the call. Well, lots of reasons that's the case. Primary reason is we're owning a portion of the company. This call is only giving us the right to potentially own a portion of the company. We don't have voting rights. We don't get dividends if dividends are paid. And this can actually lose its value very, very quickly. If this stock goes just down a few percentage points over the next 31 days, if this stock drops down below 260 and we run out of time, we could lose that full value. So there's massive risk. So the cost is less, but the risk is much greater as a percentage. So Doug's asking a question, can we do a vertical spread? We could. I'm not going to today because that would sort of be complicating this trade a bit. It kind of takes the eyes off of the discussion I wanted to have, which is just buying versus selling. And that would be buying and selling at the same time, and I'd have to get into those weeds. So I don't want to do it. So, but could we do a bullish call spread on this instead of just buying the call? Could, yeah. But we just also have to be familiar with the reward and risk scenarios and profit and loss scenarios of what produces profits or losses on that strategy. Okay, Mel Nicky says, do you factor in liquidity and open interest? That's a good question. Did anybody notice on this 260 call, it's actually gotten even a little bit wider? No, it's still about where it was. No, I thought it was around I can't remember anymore. Anyway, but there is about a $2.50 difference between the ask price and the bid price. And that $2.50 represents initially what we would call slippage. In other words, if we were just pay the ask price and buy the call and then sell immediately and receive the sell it and receive the bid price, we could lose the difference between those two. We call that slippage. And for some, when there's a wide spread between the bid price and the ask price, that's a strong indication of how liquid these options are. And They may have personal trading rules where they just don't like to see a very wide spread. For some, it might be something like, I don't like to see that spread between the bid price and the ask price as being more than 10% of the ask. In other words, about $2.50 on a $25 ask price. That's just one rule of thumb. It's not the way that everybody does it. Some may require a narrower spread still. Others might be totally fine with this. But yeah, liquidity can be a concern. And it was something that we filtered for at the start of this discussion. When we ran a scan, we looked for $100 billion companies or greater. There are only a few hundred of those. So we're at least dealing with among this stock is among the most liquid stocks out there, one of the top 300 or so. And so, yes, we could look for narrower spreads, but we're probably not going to find those on stocks that are as volatile, that are also as bullish. Our scan has already demonstrated that. Okay, Sherry says, way before any option, how do I find a stock to buy? Okay, Sherry, it's a good question. That would be a little bit off track from this discussion. We are talking explicitly about options in my Getting Started with Options webcast, but I did set up a scan for scanning for stocks on which the trader might buy options a little bit earlier. So we did address that in some respect. Good question though, but let's go ahead with this trade. All right, we're going to buy this 260 call. Yes, it costs less because we don't have ownership rights and it's only for a short period of time, and we can lose the full investment if things go wrong. But if this thing were to go up, where did we think the stock was likely to go if we just get another 40-point little burst, taking us from 260 up to 300? That would leave us with the right to buy shares for 260 at a time that they're worth 300. That's a $40 value, for which we've only paid 24 bucks. That's nearly a doubling of our investment with a comparatively normal move for this stock. And it's not even that large of a move. It's a $10, 10% move in the stock, but producing a nearly 100% return on the option as sort of a minimum. So that's a good insight into the leverage that's available here. Let's have a plan. If we can double our investment before the 17th of April, let's take the profits. On the other hand, this trade may not work out. The stock might decide this is the time I'm not going to go up 40 bucks. Instead, maybe we start to teeter over and start heading down or just go sideways. If we start to lose money instead, how about let's say our trader is willing to risk half of their investment in their effort to double it. All right. So let's have a plan to take profits if we've doubled our investment, to take losses if we've lost half. How do we put that into practice here on thinkorswim? Here's what we do. Go to the ask. There are a number of different ways to do this. Let me show you this way. We can just go to the option that we intended to buy, and we just click on the ask price, and that creates a buy order. Now, by default, that's going to be a buy order to buy 10 contracts. I'm just going to do one for today's example. So that would be to put in our entry order, but let's also attach our 2 exit orders. So to do that, we're going to change this from just a single order to what's known as a first triggers OCO. This allows us to put in those 2 sell orders. The first triggers is referring to if the first order fills, the first, then 2 other orders are triggered. The first triggers OCO. The OCO means that one of our sell orders is going to cancel the other one. One cancels other, or order cancels order. If we're able to double our investment and sell and take profits, well, we no longer need to sell with losses. So we'd cancel the loss order. On the other hand, if we do take our losses, we're not holding out for profits anymore. We need to cancel that order to get profits. So this first order will trigger a one cancels other order. User says in this screen, do we see the break-even price? Not on this one, but let me show you this. Let me come up here. Let's finish entering our order. I'm going to right-click and create an opposite order. This one will be to take our profits. We'll right-click and create an opposite order. This one will be to take our losses. So first of all, if we're buying in, let me check on something here. up here on our options chain. Let's scroll down to 260. Looks like it's still trading between about 23 and about 25. Let's say we're trying to buy in for halfway between, about $24. All right. I'm going to set that as a limit order. And then I'm going to put in another limit order to sell if we're able to exit for $48. I'm going to make that good till canceled. Now, our stop order, let's change this to a stop. That means stop the bleeding. This is going wrong. I want out of this trade. We're going to put that in at $12. And I'm going to make that good till canceled. So here's what we've just done. We're putting in an order to try to buy a call for $24 per share. That's $2,400 investment on 100 shares in the contract. We're going to sell. We're saying, hey, I'm willing to sell for $48. That's my limit. I don't want to sell for a penny less. Or if the value is dropping, stop the bleeding. Let's sell at $12. Now, this $12 order is not a guarantee that that's what we'll get. If the stock is falling hard, it's possible we might actually sell for less than $12, but that's going to be our stop order. And we make both of those two exit orders good till canceled, because we might hit our target next week or 2 weeks from now or 3 weeks from now, or maybe not at all. So this order is going to remain in effect until it's canceled or until it fills. And that's going to be the case for our stop as well. So let's click confirm and send. Going to buy this one call for $24. Going to sell either at 48, or if we drop down or below, down to or below $12. With each of these, there is a commission to be paid, 65 cents. 65 cents to get in, 65 cents to get out. That's not 65 cents per share or anything like that, just 65 cents. So you can see it increases the cost to get in by 65 cents. It decreases the credit received in getting out by 65 cents. Tracy says, so this is a long call, not a spread, right? Yep, that's right. Yeah, buying a stock or an option, we say we're long. So we are buying a long call, but this is not a vertical spread. This is VRT, not vertical. VRT is the trading symbol, not the strategy. So I can see how that could be a little bit confusing. It might look like vertical. Nope, that stands for Vertiv Holdings. So let's send that order off. And we're in for $23.95. All right. So guys, I think this was an interesting topic for discussion, because sometimes we'll just hear it stated very broadly. Oh, this is a seller's market for options, as though buyers have no right or no opportunity to be trading under such conditions. Or conditions might be described as a buyer's market, as though there's no opportunity for sellers. Well, that would mean that there is no market. Markets would freeze if everybody took one side or the other universally. We have to sort of look at things from the other perspective from time to time. And so that's what we did today. Why, for some traders, they consider a seller's market to be potentially a great time to buy. All right. So hopefully this was an interesting discussion for you. I know it's going to be a little bit different for some, but that's what's nice about the fact that we record these webcasts. If you need to go back and revisit the logic of what I proposed here today, you can go to the archives and check out today's webcast. Should be available pretty shortly. Every once in a while we run into a technical hiccup, but you should be able to find that. So that reminds me that to remind you that if you're new to these webcasts, make sure that you've subscribed to our Trader Talks channel. You can just click on the subscribe button right down below the video. It doesn't cost anything to subscribe. It only takes a second to do it. You click subscribe and you're done. But our Trader Talks channel on YouTube is where you can join these live streams, and you can also find playlists for previous episodes or webcasts. So if I were to click on playlists, if I wanted to find my Getting Started with Options, I'm going to scroll right on down to the bottom. We have a whole bunch of webcast series. Mine just happens to be right down here toward the bottom. There I am. Click on View Full Playlist. And there's last week's discussion. How traders turn stock opinions into options trade strategies. So you may want to check that one out. But make sure you subscribe, but also make sure that you're following your favorite Schwab presenters on social media. You can find and follow Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. There's my handle. There's my profile. There's one of my favorite castles in Scotland. But I'm very active on X, as you can see here as you scroll through. And if you reply to one of my posts on social media, I try to reply right back to you. So this is where you can communicate with me in between the live streams. I get that question all the time. How can I reach out to you? Social media is the answer. So on X, or you can also follow me on LinkedIn now. Just go to linkedin.com/in and then /Cameron May CS. And if you reply to a post there, I try to reply to you as well. All right, but time for me to let you go. Eva, hope it wasn't too hard on the eyes to go over to that black background for a while. But I will see you in a future webcast. I'm also going to keep an eye out on social media. Thank you to everybody that's already clicked the like button. I saw 170 people still watching the live stream. It looks like 58 have already clicked the thumbs up. That's always appreciated. It's like a pat on the back to your presenter, but it also gives my videos a nice little boost in the YouTube algorithm, helps more people find these discussions about, like, why would we ever buy in a seller's market? Interesting question. Anyway, everybody, thanks. I'll look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.